Hello, everyone. Um, my name is Hicham El Guennouni, and I'm business consultant. And I will be the speaker today in the webinar, together with my colleague Daria Soloveva. And first, I would like to start by introducing our company. Lawitt Buro MENA is a next generation consulting firm established to support international business, investor, private clients across the Middle East and North Africa. We combine legal, corporate financial expertise to help clients build and manage their presence in the region safely and effectively. And we are offering diversity of services also, starting from the services connected to market entries, for example, company incorporation, either in the mainland free zone, Dubai, Abu Dhabi, Ras Al Khaimah, and also establishment of foundations, trust. We provide also services connected to visa, golden visa, partner visa, investor, employment, freelance visa also, and plenty of other types. We are providing also the service connected to accounting and bookkeeping, tax registration, reporting, um, service also related to legal sphere, absolutely, contracts, legal consultancy. Um, and also other services that can be personalized and customized based on the needs of the clients. And the webinar mainly will be about not the laws in Emirates, but the change in the laws that happened during this year, 2026, that was already issued and published in 2025, but entered into force in this year and early this year, starting from April. Um, for most of the last decade, Emirates built law and remarkable speed, corporate tax, personal data protection law, virtual asset authority, a written competition regime, and invoicing mandate. And through most of that period, there was waivers of penalties, move of deadlines, especially connected to the difficulties that were experienced in the region. And if you were a well-advised business, you could benefit from these advantages and live comfortably inside these advantages offered by the government during this period. Over the next hour, we are going to walk you through 6 areas where the change is concrete and dated. Corporate tax enforcement, e-invoicing, audits and penalties, virtual assets, um, cross-border compliance, and finalize with AI and data layer. We will be specific about this. This is very important in our webinar because it's mainly talking about the changes and deadlines that should be respected in order to ensure full compliance with the laws. And we will end with a short action list that we think every business operating in or through Emirates should be able to answer yes by the end of this quarter. And we will finalize by receiving your questions and trying to answer it. We will be happy to do so. And now we will leave the floor to my colleague Dasha. Thank you.
Thank you, Hisham. So before we look at the details, I want to give you a simple map of this hour. So what we will cover. The first topic is corporate tax enforcement, the new posture and what the FTA, which is Federal Tax Authority in Emirates, is now able to see. Second topic is e-invoicing. This is about electronic invoicing, the model, the deadlines, and what has not moved. Audits, penalties, compliance, this April 2026 framework and the disclosure window, virtual assets, VARA and the new federal layer above it, cross-border compliance, and the last topic will be AI, cyber and data protection. So we will go deeply to the three main shifts in the legislation. The first one is we can call it from rules to data, that the tax authority is no longer reading the returns and it is somehow cross-referencing them. The corporate tax against VAT with also custom and audited accounts, and any risk now can become not just an error, but the real risk. The second shift is about from access to resilience, that Emirates competed on speed of market for years. We all know that, but now it became a little bit different. In 2026, instruments shift the emphasis to capital governance, substance, and supervisory discipline. And the last shift is from principle to machinery, that laws that existed without enforcement, now they are acquiring this enforcement and engine, and institutions are being built, and institutions eventually started to enforce the laws. So now I guess we can start with the block one, corporate tax from education to enforcement.
Saying that the corporate tax in Emirates is now 3 years old as a regime and roughly 2 cycles old in practice. So by next September, by the end of September, it will be the third feeling for companies that were already existing in the market. And this is exactly the point in the life of a tax system where the authority stops onboarding and starts auditing, and this is what we are seeing. First, I would like to say that the tax applies to financial years starting on the 1st June 2023 from the application of the law, and the FTA, which is the Federal Tax Authority, cannot audit periods preceding your first applicable financial year under this law. The legal change that matters most is the Federal Decree Law number 17, 2025, which was amended the tax procedure law with which became effective from the 1st January 2026 and did not change a single tax rate. The tax is exactly the same. There is no change in the tax itself. It is 9%. But it changed just how the Federal Tax Authority investigates, audits, and assess the procedure. The headline point is the look-back period. The standard limitation period was for an audit remains 5 years from the end of the relevant tax period, but the tax evasion, if the tax evasion is suspected or where a person who should not have registered failed to register, the authority may look back up to 15 years, and this is the change in the law. The 15 years we know, running from the date a person should have registered, is a different situation now. It means a dormant entity, a holding company, a free zone vehicle that was never registered because someone assumed it was out of the scope. The entity does not have a 5-year program, but now it's 15 years program. It can be, the case can be even revised after 15 years. On the enforcement capacity side, the FTA conducted the order of 93,000 inspection visits in 2024, and increase of roughly 135%, which is a huge increase in the inspection level. This capacity has continued to scale, and it is being deployed against a data set that did not exist 3 years ago. Which brings to me to how the triggers we are actually seeing. The FTA does not publish its risk scoring criteria, but through some authority-owned statements from our client, we can somehow mention some recurrent flags, such as a mismatch between VAT returns and corporate tax returns. If, for example, VAT declared turnover and your corporate tax revenue line do not reconcile, you cannot explain the difference in one page. At this moment, there is a problem. You need to justify the difference in the documents. The second problem can be registration without filling. Entities that registered, filled once, and then disappeared. It's also a problem. Another problem can be transfer pricing position outside the range for the sector without documentation to support them. Company is charging prices to its related entities, for example, sister companies, parent companies, etc., that do not match the standard market rate for that industry. One last problem can be weak or absent records. So I was saying that weak or absent records is also a problem. Under Article 56 of the Corporate Tax Law, accounting records and supporting documentation must be kept for 7 years from the end of the relevant tax period. And there is never where Cabinet Decision number 17/2026 requires report records to be retained for an additional 2 years in cases where a refund request remains pending and no final decision has been issued. If you have an open refund claim, your retention clock is longer than you think. So if you have a refund sent to the FTA and there is no final answer by them, the record should be kept for another additional 2 years. Now I will move to qualifying free zone person benefit. This is the case where, which is one of the most famous cases in Emirates of zero tax. In case of qualifying income, that relief is real. What is not in an exception from the regime, this type of entities still need to be registered for corporate tax in the portal of FTA. And they still need also to perform an annual corporate tax return and must maintain audited financial statement. The last requirement that this type of entities, which is qualifying free zone person for zero tax, they still need to be registered for this corporate tax and for the annual corporate tax return and must maintain audited financial statement. The last requirement is not optional and is not something that you can assemble retrospectively when an audit notice arrives. The structural risk is worth stating clearly here. A free zone entity that has not filled cannot demonstrate that they satisfy the condition to be a zero tax company. And when eventually asked to, it has no contemporaneous evidence, no filing, no audited records, no substance documentation. At this point, the 0% is not being defended. What I mean by defended here is handing the tax authority pre-existing audited financials, real-time transfer pricing files, and official logs. You are simply showing what you already did in the moment when it was the transaction was already happening. More importantly here, there is cases of restructuring, which can be expensive and not all the time successful. What I mean by restructuring is scrambling years later after the tax audit notice arrives and try to generate bank statements, hire accountant to back this paperwork, conduct delayed audits, and to create proofs in another words. And this is a problem, which, as I said before, it is not easy, it's expensive and not all the time successful, and it is hard to defend in front of the authorities when they ask for proofs. I would like to finish this section by talking about the late corporate tax registration attract an administrative penalty of 10,000 dirham, but the FTA operated a waiver initially for that penalty at the beginning of this year, early 2026, and more than 68,000 companies benefit from that, from the late of 2025 and 2026. And for a company with a financial year ending 31st December 2025, the end of last year, the waiver window closed at the end of this month, which is already a few days. And if you are in the position and you not feel that this is the single most time critical item in the today session, since just 3 days left in the month to benefit from the waiver. And now I think we can move to the invoicing, which is the topic most recent in the tax law in Emirates this time.
Yeah, thank you, Hicham. I want to start this section by fixing something because there is a rumor going around and you believe it, it can cost you some money. So since May, I have heard some same sentences from clients that electronic invoicing has been postponed and we have time. But this is not true. And what happened is that in May, the Ministry of Finance moved one date, and this date was moved by 3 months, and this is all. And the main dates when electronic invoicing becomes compulsory, they didn't change. So if your company slowed down in May because someone said that this is postponed, we should restart this project this week because the problem is there could be some months lost. So what electronic invoicing really means? First of all, the name can be misleading. Most people call it electronic here, that electronic invoicing, and think we already do that because we send invoices by email and as PDF files. But this is not what it is. And to show the difference, we can use the simple picture. Imagine that you send me a photograph of your passport. I can look at the photo, I can read your name, but the computer cannot use it. It is just an image. And now imagine you hand me the passport itself with this chip inside, and the machine reads it in 1 second. The name, number, date, it's all already in the system. So the PDF file is, or PDF invoice is just a picture, but electronic invoicing, it is like a chip. So it is not a document that just looks nice. This is the information in a fixed structure that the computer can read directly and with every field in exactly the right place. And here is the second thing, that we can expect that the government to build a website where we can upload all our invoices, because many countries do it in this way, but Emirates did not. Instead, invoicing in Emirates works in another way. We send the invoice through a licensed company called Accredited Service Provider. I will say provider from now on just to make it shorter. That provider delivers it to your customer's provider. At the same moment, sends the required data to Federal Tax Authority, the FTA, which is Emirates Tax Office. So the invoice reaches your customer and the tax office at the same time. So, three things companies discover too late. The first one is that the accounting software, it either does this, either it does not. Because your system can produce a structured invoice in the required format, or it cannot. If it cannot, then you need an update or add or just install a new system. So I recommend to ask your software provider, like, are you ready for Emirati electronic invoicing, and what exactly do we need to do? Yeah, and the second thing is that you can't do it alone because the provider is not optional. You cannot send invoices directly, no matter how good your systems are. And choosing a provider is not a small task because you have to compare them, you have to sign a contract, then you have to connect them to your system and test it. And this is three separate pieces of work, and it could just take months or not just weeks. And the third thing is that this is nobody expects that the data can become everybody's problem. Because right now, if a customer's tax number is missing from the system, what can happen? Somebody can notice it, then another person is fixing it, and it is annoying, but it stays inside your company. After electronic invoices, the same missing number means that the invoice is rejected. It will not arrive to the customer. Your customer just cannot receive it. So, and if invoice never arrives, it means it will be never paid. So, this is not just like tax question. It is a question about the cash flow. So what about the dates? We have 4 moments. Since 1st of July 2026, the voluntary phase is open and we can start introducing the system. the 30th of October, this is the day which was moved and which was confusing to people because it was 31st of July and now it became 30th of October, and large companies must have appointed their provider. So it is about 3 months from today. And the 1st January is the date when electronic invoicing becomes compulsory for businesses with annual revenue of 50 million dirham or more. And for other companies, during 2027, it will be extended to VAT registered businesses and then to government bodies. So special arrangements for invoices inside the same group of companies run longer. So about this point, the exact order of these stages, they has been described differently by different advisors, and the authorities are still publishing the guidance. So we don't know exact dates for each company now. But what we know is that it covers business to business and business to government invoices. So selling to ordinary customers is outside the rules for now. But I don't know, for now it doesn't mean forever. Another practical point, if you have a smaller company, if you're thinking that this is not my problem yet, that the thing is that your large customers can move first. And if they do, they will expect the suppliers to fit into the process too. So in practice, the pressure can arrive from your customer before it even arrives from the regulator. So the real deadline is earlier, the January 2027, but we just need to keep this date in our mind. So what should we do exactly? Now this month, there are two questions to be asked. First, the accounting software provider, whether they are ready for this or no. And also ask your finance team how clean your customer and supplier data is. Before October, you should choose your provider and sign the contract with them. In the fourth quarter and first quarter, the system should be connected, and the system you choose should be tested internally. And the last step is, and my strongest recommendation is, start sending real electronic invoices voluntarily before you oblige to it. Because every system works like this, that there could be some errors, they're all the time happening, so it's better to be found before it's too late. Yeah, so I will now hand back to my colleague for penalties and audits part. Thank you.
Yeah, thank you. Concerning the penalties and voluntary disclosure, it was one of the biggest changes in this field, and we can say that what was interesting about the topic is there was a reduction in the fees, and this is something unusual in this field, and it can tell us something about the intention of the policy of the tax system in Emirates. The cabinet decision number 129 of 2025 that was issued in 2025 and starts to become effective from April 14, 2026. It replaced the penalty table that had governed since 2017, as subsequently amended. And the ministry stated aims were to be the process to be simplified, to be proportional and transparent, and encouraging voluntary compliance. The design is behavioral here, and it makes honest error cheap and makes concealment expensive. So the old model was punishing and difficult to model, an immediate charge, then a compounding monthly charge, up to ceiling of 300% of the tax. That is no longer working now. From April 14, 2026, in-paid tax attracts a flat 14% annual, calculated monthly on an outstanding balance, approximately 1.2% monthly on the principal not compounded into itself. And the old regime, a 3-year-old liability could exceed the tax itself several times over, which creates a burden for entrepreneurs and for companies, especially if small companies. Under the new one, the cost of delay is roughly linear and predictable. Um, so we can say that the positions that were commercially installed 18 months ago may be worth resolving now under these new changes. The old system used set band penalties escalating from 5% to 40% of the tax difference, depending on how long the error has gone incorrected, and materially higher where the disclosure came after an audit notification. So we can differentiate here between two cases. The case when you disclose or you correct the mistake by yourself before you receive an audit notification. And the penalty is 1% or per month of the tax difference running from the original date until the disclosure is filled. And the second case, when you move only after you receive a notification, the disclosure after an audit notification has been issued. An additional fixed 15% of the tax difference applies in this case, and on the top of the monthly charge also. So we can just briefly say some of these reductions of the penalties. Some of the penalties down from 20,000 to 5,000, others from 10 to 1,000, is like 10 times less. So it shows very, very strong intentions to make the tax system more suitable for entrepreneurs. And here we can say that we have some compliance strategy based on four elements. The first one is run a self-review before someone runs one for you. So reconcile corporate tax to VAT, to audit financial statement, to custom data for every open period. So we encourage companies to review their tax reports and to declare or to admit their mistakes without receiving any notification from the FTA. The second one, treat voluntary disclosure as a commercial decision, not as an admission of failure. And it's also strongly connected to the first one. The framework is explicitly designed to reward self-correction. That's why I said before, it somehow makes the honest errors cheap. Quantify the exposure, model both scenarios, disclosure now at 1% per month versus discovery late, and this can cost the company 15% plus the monthly charge. And it's easy to take decision based on these numbers. The third one can be, as an advice, fix your record before you fix your position. A defensible position with no supporting documentation is not a defensible position. Contracts, invoices, board minutes for related party transactions, transfer pricing documentation, attendance record for entertainment expenditure. The idea here is just to have records, to have everything documented and saved in case of necessity, either after 5 years or 2 years in case of suspended cases or no final answer from the FTA, as mentioned before. The last one can be when the audit notice arrive, respond in a controlled way. Do not produce documents in this case. And it's, as I said before, expensive, hard sometimes to prove some transactions. And before you answer the first question, whether preemptive disclosure is still available to you, and probably the situation can be still solvable without generating any document after the notice, and the FTA can provide also solution in that case, as you show some good intentions to solve the problem and to pay the taxes. Now we can move to a little bit different topic, which is related to virtual assets, which is known as VARA, mainly in Dubai. Thank you.
Yeah, thank you. Before I begin, because some of you are thinking we are not a crypto company, this section is not for me, but this can be important for you for one reason. If you accept payments in digital currency, if your group holds any digital assets, if you have ever issued a token, even a small one, even years ago, if you're planning anything in this direction, then this section could be interesting for you. So what happened at the federal level? Let me start with the simplest possible summary, and then I will add the detail. The Emirates built a new national regulator for this sector and gave it a completely new rulebook. Here is the detail. There used to be an authority called the SCA, the Securities and Commodities Authority. You can think of it as a national police officer for investments and financial markets. In 2026, that authority was replaced by a new one, the CMA, the Capital Markets Authority. New name, new powers, wider responsibilities. This happened through two laws, Federal Decree Law 32 and 33 of 2025, and it took effect on 1st of January this year. Then in April of this year, that new authority published the rulebook for digital assets. And now I need to stress one single word, because this word decides how much work you have to do. The new rules do not change the old rules, they are replacing them. So let me make the difference clear, because it is like what is important here. As an example, if your landlord repaints your apartment, you stay in the apartment. Life continues. This is a change. If your landlord says, this building is being demolished, here is the address of a new building, and you must move. This is not just a change, this is a real move. You pack, you transport, you reconnect everything. So the digital assets rules in the Emirates were not repainted, the building itself was replaced. So if you hold the license under the old system, please do not assume that someone in your company will simply tick a box and continue. You have to look honestly at what the new rules require and compare that to what you actually have today. What the new rule book actually asks for two things. First one, licenses now follow what you do, not what you are. Under the old system, there were three broad categories of regulated activity. Under the new system, there are seven, each licensed separately. They include running an exchange, holding clients' assets for them, acting as a broker, giving advice, managing portfolios, arranging transactions, and operating trading infrastructure. Why does this matter in practice? Because it's very easy to drift. Let me give you another example we see most often. Imagine you were licensed. Nobody made a bad decision, nobody intended to break a rule, the product simply grew and the license did not grow with it. So this is exactly why we now run a license review for every client in this area. And I will be honest with you, we find this problem more often than we do not. Now the part that causes the most confusion, who is in charge of you? Here is the thing that surprises almost every international client. The Emirates is not one single regulatory space for this sector. The first area is Dubai. Digital asset businesses set up in Dubai are supervised by VARA. VARA is the Virtual Assets Regulatory Authority, Dubai's own dedicated regulator for this sector. Area 2 is the DIFC, Dubai International Financial Center. This is a financial zone with its own legal system and its own regulator, the DFCA, and it has their own rulebook. Area 3 is ADGM, Abu Dhabi Global Market, and here's the same idea. Abu Dhabi, own regulator, the FSRA, and again, its own rulebook. And now is the critical point that the national rules for digital assets specifically exclude those two financial zones. Which means that if you are following the rule book of one area while you are actually operating in another one, nobody will congratulate you for following a rule book very carefully. It's just the wrong book. So now some genuinely good news, because it is not all complexity. There used to be a real problem. The company licensed in Dubai often needed a second license to serve clients in the rest of the country. Two licenses, two sets of paperwork, two costs, and that has been solved now. And under a cooperation arrangement between the national authority and VARA, a company licensed by VARA is registered nationally and may serve clients across the Emirates without the second federal license. This is a very good simplification. But and I have to be careful here because clients overread this, that VARA license does not cover everything. It does not reach into DAC or a DGM, and it does not remove your obligations in the areas the central bank still controls, such as anti-money laundering duties and payment tokens. So the first question we asked a client is never which license would you like? It is three questions. Where is your company actually registered? Where are your clients? And what exactly do you do for them? Those three answers can give you a map. What changes in Dubai specifically? VARA published an updated rulebook for exchanges effective 31st March 2026. There were two changes. First one is that more advanced products are now permanently allowed. Futures, options, contracts for differences, perpetuals, the trading products, the industry has wanted for years. And this previously existed only under temporary or pilot arrangements. Now they have a proper permanent home with authorization and supervision. A second change is that ordinary retail investors may participate, but within the controlled limits. Firms have to check that the product is suitable for the clients. There are limits on borrowing to trade. There are real disclosure duties and real risk controls. If you put those two together and you see the pattern of this whole period in one line, that more is now permitted, but less is permitted casually. The market got wider, the standard got higher. And now something that catches people badly, the white paper. If you have ever issued a token or you're planning to, we need to understand that most people write a white paper the way they write a brochure. Ambitious language, optimistic numbers, some promises about the future, a disclaimer at the end that hopefully covers everything. But this is the wrong way to think about it now. Because what you wrote about the total supply, about what the token can be used for, about who governs it, about when the team's token unlock, and what you will do with the money you raise. Those are not marketing sentences anymore, they are commitments you can be held to. The comparison I use with clients is very simple, that you thought that you were writing an advertisement and the regulator is reading it as a contract. So my suggestion is quite direct. If you have published a white paper, take it out this week and read it as if you were an unfriendly lawyer looking for a promise you did not keep. This is exactly how it will be read if there is even a dispute. So two quick practical items. First one is the travel rule. In Dubai, when digital assets move above 3,500 dirham, information about who sent them and who received them has to be collected, checked, and passed along with the transfer. This sounds administrative. It is one of the most common problems found in supervisory reviews. It is worth checking that your process actually works rather than assuming it does. And the second one, a signal worth noticing. A cabinet decision from 2025 formally connected VARA into the corporate tax framework. It does not create new obligations for you today, but it tells you the direction. The regulator of digital assets and the tax authority are being wired together, not kept apart as it was before. So what should you do? Four things. One, if you operate onshore in the Emirates or serve Emirati clients from outside the financial free zones, review your license against the new list of 7 activities. Ask honestly, is what we do today still what we are licensed for? Second thing, compare your capital and governance to the new standard. Not the standard you were approved under, but because they can differ. Third thing, read your white paper again with fresh and unfriendly eyes. And the fourth one, if you have to move into the new system, start as soon as possible. The transition period has an end date, and the regulator has made it clear that it expects the compliance. So now you will stay with me for the next topic, because next session is mine as well. We move from one industry to something that affects almost every company. In this room, what happens when your business crosses a border? Okay, so So this section is for anyone whose business does not live in one country. A company here and a company somewhere else, owners abroad, customers abroad, money moving between countries. The first topic concerning our blog is the global minimum tax. Because you may have read about a global minimum tax of 15%. So I will be quick because it only applies to very large international groups with worldwide revenue of 750 million euros or more. If that is your group, if this is not your group, this is not your problem. But if it is you, then of course. Two things if you think you might be close or if you advise someone who is. It is a separate registration on Emirate Tax portal. It is not part of the normal corporate tax return, and standing in the first line does not mean you have been served at the second. And the Emirati system is internationally recognized, which means that the tax is collected here rather than by another country. The second topic is that tax authorities are about to start sharing crypto information. Bank accounts stopped being private between tax authorities years ago. If you're a tax resident in one country and hold a bank account in another country, that information is very likely already being exchanged automatically. So it just happens once a year. Digital assets were the exception, not because anyone decided they should be, just because the system was built before crypto existed. That exception now is closing. Emirates has signed the international agreement that creates the legal basis for exchanging crypto asset information the same way bank information is exchanged today. The Ministry of Finance will publish the technical detail, the forms, the formats, the registration process. Alongside it, the older system for bank information is being widened to cover more types of institution. So the Emirates' first exchanges are expected in the 2027 to 2028 window. But, and this is the part I most want the European-facing businesses to hear, that Europe didn't wait. European Union began collecting crypto asset data on January 1st, 2026, 7 months ago. The first automatic exchanges are scheduled for September 2027. So if you are in UAE digital asset business with European clients, you are not preparing for something in the future. You are inside the collection obligation that started at the beginning of this year. For that group, this work is not early, it is already quite late. Now the practical consequence, and it is more painful than it sounds. To report, you need real information about your customers, where they are tax resident, their tax identification numbers, signed confirmations from them. Collecting that from a new customer is easy. You just simply add this to sign up process. Collecting it from your existing customers is an entirely different project because you have to contact them. Many will ignore you. Some will have moved. Some will not understand what you're asking or why, and you cannot report data you don't have. So this is a genuinely one of the least enjoyable projects in compliance, and every single client underestimates how long it takes. So my advice is short: give this to one named senior person now, and not a committee, just one person with authority who can do this job about the substance and the band behind it. That now something that applies to almost everybody here. The formal rules first, briefly. Transactions between companies in your own group must be priced at if the companies were strangers, and you must be able to show how you arrived at that price. You can create a taxable presence in the country through the people working here, regardless of where the contract was signed. And free zone benefits depending on genuinely doing the qualifying activity, not on the address printed on your license. This is the law. And now let me tell you what actually decides these things in practice. The bank. I want to be direct because clients still arrive with old expectations. The era of easy, light touch banking in this region is finished, and I think it's not coming back. Today, whether a structure works is not really decided by whether it is legally correct. It is decided by whether a bank will open the account, and harder, whether the bank will keep it open 2 years later. Banks now check sanctions and money laundering risk for more carefully. They want documented proof of where you are tax resident and and they want that proof to match what will be reported automatically under the exchange systems. And they want a clear, consistent explanation of where the money came from. So when we design a structure today, we ask two questions. The first is the lawyer's questions: is it compliant? And the second is practical question. And honestly, this is the one that decides the outcome. Can a bank accept this? And can the client explain it in 3 sentences to a compliance officer who has 15 minutes and 40 other files on the desk? A structure that passes the first test and fails the second one, and fails the second, will fail. It will be legally perfect and commercially useless. So if your structure needs a diagram and 20 minutes to explain, this is not a sign of sophistication. This is a warning. And the fourth topic is two things happening right now. Both of them are immediate, so I will be quick and specific. That competition approval for transaction will change in 2 days. Emirati competition law finally has its detailed implementing rules, and they come into force on 30 July, like in 2 days. Two consequences for if you buy or sell businesses. Deals that previously needed no approval may now need it. So if you have a transaction in progress, please check this immediately. And approval takes time, and it has to be built into your timetable rather than discovered halfway through. And the review may involve more than one authority, which affects both how long it takes and how confidential it stays. And the second thing is about emiratization for companies only in the mainland. That since 1st July this year, employees who do not meet the criteria no longer count toward your quota. So a company can believe it is compliant and quietly not be, because the arithmetic changes underneath it. There are also significant financial penalties for arrangements where Emirati nationals are employed on paper, but genuinely but not part of the workforce. The fines are between 20,000 dirham and 100,000 dirham per worker, and the monitoring is automated. So, non-compliance can suspend your ability to obtain new work permits. For a growing company, this is far worse than a penalty because it can cost some money. Yeah, so to summarize my section, if your business crosses a border, you need to ask 3 questions. Do you handle digital assets for clients in Europe? If yes, you are already quite late and you need one person owning it. The second question, can a bank understand your structure in 3 sentences? If not, we need to fix that before we need to fix something else. And the last question, do you have a transaction in progress or are you hiring on the mainland? Because two rules changed this month, one of them day after tomorrow, so we need to look at it now. And now I will hand over to my colleague for our final subject today, artificial intelligence, cybersecurity, and data protection.
Concerning this topic, I will be a little bit short about it, and then we can move to something more practical, because until this moment there is no specific law issued by Emirates about AI and the usage of AI, but we can still find some relevant articles in this context. For example, Article 18, which restrict decisions made by automated processing where those decisions produce legal consequences or otherwise seriously affect the data subjects, absent consent, contractual necessity, or a legislative base. This article is, in practice, the Emirates operated AI provision, automated credit decisioning, automated screening in the recruitment processes, for example, automated pricing or eligibility decision affecting individuals. Those sits squarely within it today. You will see advisory publication citing a compliance date of 1st January 2027. Treat us with care. Some of those references conflate that PDPL, which is personal data protection law, with other instruments that do not carry that base, including the Child Digital Safety Law, Federal Decree Law number 26 of 2025, which took effect on the 1st January 2026, with full compliance required by 1st January 2027, which means that some laws are already applied and has a legal effect. But in this point, I want to take away the absence of implementing, for example, regulation is not the absence of obligation. It does not, if there is no law, it doesn't mean that there is no obligation, absolutely. And the principles of the PDPL bind now. And the series of other instruments already impose binding data and confidentiality obligations regardless of the cybercrime law, federal decree law number 34 that was issued in 2021, which has very broad reach, the healthcare ICT legislation, sectoral requirements from the central bank, and financial sector legislation that was issued in 2025, just to show that there was somehow a path of trying to regulate this field and try to provide high level of protection of data starting from 2021, as I mentioned, and still ongoing until now. In order to give some examples, I will rely on two free zones, which are somehow benefit some autonomy and they are famous to be more specialized. And we can start with the AFC. The data protection regulations were amended to introduce regulation number 10, which imposes specific obligations on entities deploying autonomous or semi-autonomous system, including generative and machine learning tools that can be considered parts of the AI, that process personal data. It has been on the book since September 2023, and it moved to full enforcement from January 2026. Regulation number 10 of the AFC requires impact assessment, transparency to data subjects about AI-driven decisions, recognition of the right or to object in the context of profiling and automated decision-making, and documentation of high-risk use cases. Penalties in this context can be a little bit high, going to $25,000 to $50,000 per violation, and separate. Failing to conduct a data protection impact assessment before commencing high-risk processing carry out exposure, as I said before, to $50,000 as a fine. So the position stated here is that DFC entity using AI to process personal data has enforceable AI-specific obligations today. A mainland entity has principals and an emerging supervisor. Groups with entities in both needs a governance framework built to the higher standards, because running two standards inside one group is not workable in practice. I would like to finish with ADGM, which is another free zone in Abu Dhabi, which also under its 2021 data protection regulation is closer to GDPR, including a legitimate interest basis, standard contractual clauses for transfer, and adequacy list that broadly track the European one that already started to regulate the field of AI and the data protection, and on entities that are employing artificial intelligence in processing the data of clients or users or whatever, depending on the business model. And to finish our topics, here we provided some of the dates that are very crucial and very that some of them already binding, already in force and has some legal effects. Here we have some 6 questions. If after this webinar and this presentation, you will be able to answer yes to some of them, and in that case, an action will be required absolutely. The first one is, have you reconciled corporate tax, VAT, and audited account for every open period? The second one, have you qualified historic exposure and decided on disclosure while still pre-notice? The third question is, have you started the e-invoicing readiness with an SAP plan before a SAP plan before 30 October? The fourth one, have you mapped virtual asset activity against the new federal licensing categories? The fifth, do you have an inventory of every system, make an automated decision about people? And the last one is about the cross-border businesses above 750 million. Finally, I would like to discuss one of the most important topics, which is connected to the banking system in Emirates, and which is creating big problems to some of our clients and clients in general in Emirates. And here I would like to simplify a bit the structure of the system or how it's working. First, we need to understand that banks in Emirates or the system in Emirates classify countries from low risk to high risk countries based on the risk of money laundering, of sanctions, and the more the entrepreneur or the shareholder is or scaled high risk to the bank, the more the difficulty to open a bank account, either personal or corporate. The more personal is even more since the business, the corporate, at least the business is established in Emirates, and it gives some kind of credibility to the case. The second aspect, which is the nationality, of the shareholder itself, which is the second aspect is connected to the activity and not to the nationality. I'm sorry. The first one is connected to the nationality. The second one is connected to the activity itself. Activities in Emirates are also classified from low risk activities to high risk activities, and when it combines together high risk nationality with high risk activity, the case starts to be truly difficult and needs some special treatment. And this is where our job starts, to provide orientation to our client, to provide the correct documentation, suitable answers, orienting them to open bank accounts with less difficulty in these cases. And at the end, according to the law in Emirates, every nationality has the right to open a bank account, either personal or corporate, regardless of anything. You need just, as my colleague mentioned before, you need just to provide proofs for every transaction to prove that you have experience, for example, in the business that you have. You can prove everything. If we can say, you need to prove everything to show good intentions from your side to the bank side. At the end, also banks policy change from one to another, so the choice of the bank itself affects the case. And I was also now just discussing the case of companies established in Emirates, but still there is the case of offshore bank accounts that can be opened in Emirates, but still with higher difficulty since the business itself is not incorporated in the country. More requirements will be required in that case related to the higher turnover, should have some existence in the market, long lasting. In some cases, they ask at least 3 years of the presence, that the company has some presence in the market, operating already, to show some good intentions also from the side of the shareholders. And I would also to mention the tax system also, just to not confuse the attendance by the system. It starts with, in case of establishing a company in Emirates, there is the first registration of corporate tax that should happen no less than 3 months. Within 3 months of the incorporation, there should be registration to the corporate tax. Otherwise, there is a penalty of 10,000 dirham. Then, after the end of the financial year, um, there should be, after 9 months, there should be the corporate tax filing. And absolutely, there is the VAT registration that this applies only to clients that are serving clients inside the country. I mean, here inside Emirates and not outside. In case of outside, there is no registration for VAT. And VAT is, it can be registered voluntarily even before becoming as an obligation according to the system. Anyway, we can answer um, some of most requested questions in the markets in Emirates, which is now connected to the e-invoicing, for example. If it is postponed, no, it is not postponed. One preparatory deadline moved, the appointment of the accredited service provider from 31st of July to 30 October, which gives just some time more to the entrepreneurs and companies to comply. The mandatory implementation dates are unchanged. Large taxpayers still comply from 1st January 2027. And this is just concerning the e-invoicing. I want also to assert this point again about the companies that are eligible for zero tax in the market. They are still also obliged to register for corporate tax and to do their annual corporate tax filing. If they are benefit from the fact of zero tax, it doesn't mean that they are not required to report and to comply with the system. Yeah. Thank you also so much. I would just to finish by one of the most now important or repeated question. If Emirates is still a good place to start a business, I would like to say yes, it is. It is just now somehow a different market. Now it is more mature market, it's more international, it has started to become more and more structured market, and it is supported by the presence of some big companies like Binance, for example, in the field of crypto license. For example, when they took it last year, they gave some strong signals about the importance of the markets for the companies that they are trying to access the MENA region. Emirates became, I can say it now, became the best option for those type of companies, and it can provide some kind of trust to the client or to the client of the companies, because they can see that they are established already in a company which is in the region, which is with some high demanding high level regulations in this field, which can somehow be problematic and high risk for the client because they are investing a huge amount of money. So I'm saying yes, it's a good market. It's good. It provides some very good benefits, especially now with lower level of penalties and more tax incentives to companies. And thank you so much for attending our webinar. Thank you so much.